So let's take a closer look at support and resistance levels. Let's begin with resistance levels or zones. Now, when you first look at a chart, you have to see if there are any potential resistance levels or zones. So what does it mean? A resistance is when you take a look at a chart and notice that there are certain price points where the price tends to converge. In other words, notice the price going up, reaching a certain level, and then reversing back down again. And it keeps repeating that process. Price goes up, reaches that same level, converges there, reverses back down again. So for example, if you take a look at Boeing over this period of time, notice that price goes up to about $95 and then reverses back down again. Goes back up again to that same level, $95, and reverses back down again. And once again, goes back to 95, reverses back down again. Goes back up there, reverses back down again. So it seems that at $95, there's something that seems to be preventing the stock from moving further up. And what it is would be more supply than demand. In other words, many sellers are waiting there so that the moment the price reaches that level, they tend to come in and they overwhelm the buyers and reverse the price down again. So whenever you see the price hitting a certain level 3 times or more, it is a significant resistance level. And we can draw a line connecting these points on the chart, and we call that a resistance level. Now, a few things you have to understand. And the first thing is that we call it a resistance level or a zone. Although we draw a line, but it's not technically a line. Why? Because in reality, price doesn't go exactly to a line and come back down again. For example, if this happens to be a resistance level, okay, the price would sometimes go up, touch that level and come back down. It may go up and sometimes it goes beyond that level slightly and comes back down. Or sometimes it may go near to that level, hardly touching and coming back down. And goes up again. So, in other words, it's not exactly like a brick wall, right, where the price would hit that wall exactly and come down. Think of it more like a fence, where the price hits the fence stretches a bit sometimes, right, and it bounces back off again. So it's more like a zone rather than a line, so to speak. Okay, so in looking at resistance, we have to give buffer. That sometimes it may go a bit beyond that line that we draw, or in fact it may sometimes fall a bit short of that line. Okay, so how would we draw a level of resistance? So what you do is, again, look at the price candles, and if you notice the candle going up, coming down, going up again, coming down, going up again, coming down, okay, and you notice, hey, it tends to be stopping at this level of 87. Now, question is, where do we draw the line? Do we draw the line at the extreme point, say at here where it touches 1 point, or do we draw it here? Now again, this line is supposed to be straight, right? So forgive my drawing. So A or B, where do we draw the line? Okay, so personally I would tend to draw it at B. Why? Because I want to draw the line where it touches as many price points as possible. I'm drawing the line of best fit. So this line is touching 4 price points, whereas line A only touches 1 price point. So line B is more significant. The more points it touches, the more significant it is. So I repeat again, a resistance line that you draw has to touch at least 3 points for it to be a significant resistance level. Now, if you see 2 points and you connect 2 points together, that could be a probationary resistance level. Okay, but it's got to touch the 3rd time for it to be a confirmed resistance level. So, why do we want to draw these lines on a chart? Well, because they tell us that supply exceeds demand at those levels. So here's the thing. When a stock price fails to break a resistance level, it tends to create bearish momentum. So because of that, we avoid buying stocks when they're moving towards a resistance level. Alright, so let me repeat that again. Before you want to enter a long trade, before you buy, you always check, hey, is there a resistance above my entry price, my intended entry price. If there's a resistance, don't enter the trade, because the probability is that the price is going to go up, hit that resistance level, and come back down again. Now, again, it's not a guarantee, but it's a probability. So if there's a higher probability that price can't break through a price level, why do I want to enter the trade? All right, so that's resistance. Now, next thing, when a stock price is able to eventually break above a resistance level, especially a strong one, it creates bullish momentum. For example, in this case, Walt Disney found very strong resistance at 35.30, right? So it found resistance, 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 resistance. So this level was tested 1, 2, 3, 4, 5 times. That's a strong resistance level. And again, the stronger the resistance, the stronger will the stock run if it breaks that resistance level. Okay? So eventually in November, what happened? That's right, the price broke above that resistance level. In other words, there was enough demand, enough buyers to overcome the very strong sellers that were waiting there. Okay? So the moment you see a price breaking out of a strong resistance level, there's a high probability that the price will run. Think of it as a person stuck in jail, right? So he attempts to run out of jail and he gets stopped by the guards, right? And eventually what happens when he's able to break free or break out of that gate? That's right, he runs for his life, right? So again, many traders look to buy when a price breaks above a resistance level. We call this trading on a breakout. Now again, in reality, it's not always so simple. Sometimes the price may break out of that resistance level and come back down again. And we call that a false breakout. And false breakouts happen frequently in trading to fake out amateurs. Alright? So I'll be sharing with you in the lessons to come how do you identify false breakouts. Okay? Because they do happen at times. So that's one thing to take note of. Avoid buying when it's below a resistance level. You only want to enter when it's broken above a resistance. Alright? And there are clear skies ahead. Now, similarly for support zones, you have to identify them on the chart. So what you want to do is to look at the chart and notice that when price comes down, does it reach a certain level and reverse back up again? And does that pattern repeat at a certain price level? So in this case, it does, right? Notice price, in fact, gapping down violently and going to $66 and reversing back up. Then coming back down again, reaching that same level, reversing back up again. Coming down to that level and reversing back up again. So what does it tell you? It tells you that obviously at $66 or between $66 to $67, there are very strong buyers waiting to buy when it reaches that level. So demand exceeds supply at that level. It's overhang of demand. So when you see that, and you can see that the price touches a point at least 3 times, that's a significant support level. And we can draw a line connecting those 3 points like so. There you go, right? So if you've got 2 points, you can connect a line, but it's not significant. It's a probationary line. It's got to connect at least 3 times. And like what I mentioned earlier on, support levels are not like brick walls. Okay, it doesn't hit exactly that level and bounce off all the time. Sometimes it goes through that for a while, it falls short. Just like a fence. So once again, let me just illustrate. If I've got a line over here, that's supposed to be a support level, alright? Supposed to be straight, right? Price comes down, and again, it may touch that level, go up. Sometimes it may touch and go out a bit, and sometimes it doesn't even touch. Okay, so you got to give a bit of buffer again above and beyond that line. It's a zone. Alright, and again, how do you draw the line? You draw it where it touches as many points as possible. You draw the line of best fit. Now again, why is it important to identify support levels? Because if you are selling short, right, you're shorting the market, shorting the stock, you do not want to short just above a support level. Because if you short it, what happens, right? It goes down, hits that level and bounces back up again, and you're losing money. Okay? Because when a stock bounces off a support level, it creates bullish momentum. It tends to rise back up again. So avoid selling short when the price is near a support zone or support level. Now what happens if price is able to eventually break a support level? Right, so price hits $33, right, and reverses, hits it, reverses again, reverses. So there are very strong buyers at $33. As you can see, very strong buyers over there. It touches many times, very significant line. So eventually what happened? It breaks, which means suddenly the sellers overwhelm the buyers, right? There are not enough buyers to absorb the sellers wanting to sell. And the moment it breaks, what do you think people do? People panic and say, oh my God, right? There are no more buyers left. So no one dares to buy. Yeah, there's no more support. And the price tends to free fall from there. So again, this is where a lot of short sellers tend to enter short when they see a significant support level being broken. And again, do know that in reality, there are false breakouts. So sometimes the price can go below that and people start shorting and it starts going up again. Right? So we call it a false breakout. So you got to be careful of false breakout. In specific strategies, I'll talk about how do you avoid some of these false breakouts in trading. Right? The next interesting phenomenon to understand is that when a stock breaks a previous resistance, that resistance becomes support. Okay, and vice versa. So in this case, notice resistance, 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 right? Really strong resistance. And over here, what happens? It breaks the resistance, goes up, comes back down again, and what happens? This time, boom, boom, boom. That resistance has now become support. Okay? So when people often ask me, hey, is that a support or resistance level? And I say it is both. It is both. Because when price is below it, it's a resistance. Once price gets above it, it becomes support. Okay? Now the opposite is true. When price breaks a support level, for example, say it breaks this support, that support now becomes new resistance. Right? So that is how it works. Here's an example. So again, support, 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 breaks support, goes up there, doesn't exactly touch it, but you can see it's near enough, comes back down again. But this time, boom, it hits that support, which has become resistance. Comes back down again, goes up one more time, hits that same resistance, comes back down again. So really significant, important levels to look at when trading. Alright, so support and resistance levels don't always come in horizontal lines. They can also come in diagonal lines. So we call those trending support lines. So if you look at a stock on an uptrend, in this case, and again, how do you define an uptrend? Higher highs and higher lows. Right? Do we have higher highs? That's right, higher highs and higher lows. Right? There we go, higher lows. Okay, so whenever I see a stock on an uptrend, I will see if there is a significant uptrending support level. Okay, so how do I do that? I look at the low points. I look at the lows, right? So this is a low, that's a low, or we call this swing lows, right? Swing lows, swing lows. And what I do is I see, can I draw a line that connects at least 3 swing lows into a line? If I can, I will draw it. Now it doesn't always happen, so don't force it. But you can see very obviously that a line can connect 3 swing low points. You can draw that, and that tends to be a significant line. So in this case, notice that there is one. There we go. Alright, so we connect this low to this low to this low to this low. What happens? In fact, it forms a very strong trending support. Okay. So how can we use this? Well, we can use this in the following ways. That we know as long as price remains above this line, the uptrend prevails. Okay, and the best time to enter long is when the price retraces to this support level. So whenever it retraces and it bounces off the support level, that's the time to buy. Boom, time to buy. Boom, time to buy, right? So it gives you a very good reference point when to get in on an uptrending stock, when it retraces and bounces off that support level. And of course, when it eventually breaks this line, that would be a good idea to take profit, right, and to exit the long trade. Okay, so that's uptrending support. The opposite would be downtrending resistance. So if I see a stock on a downtrend, and again, how do you define a downtrend? That's right, lower highs and lower lows. Okay, so when I see a downtrend, I see if I can connect the high points to form a resistance level, a trending resistance. So I look at all the highs and say, okay, can I connect at least 3 points together to form a line? If I can, I would draw it. If I can't, I won't force it. Doesn't always happen, right? So in this case, boom, it happens to be that, right? So 1, 2, 3, there we go. We can draw a line. So the moment if you had drawn this line, it would have become a really good reference point, right? So the moment the price went up there and hit that line, what would you do? That's right, you will sell short, and boom, it goes down and you have a good profit, right? Reverses back up again, that same level, right? You could have shorted it and boom, would have dropped down. Go up again, boom, short it, drop down. So as long as the price remains below that trending resistance, the downtrend prevails. You do not want to go long, you want to stay short. And of course, eventually, if the stock breaks above this resistance, all right, then you do not want to be short anymore. It could be an indication of a change of trend. So let's take a look at some examples from the charts. All right, so let's take a look at how we would draw support and resistance levels on a chart. So you can use any kind of charting software. They all allow you to use drawing tools. So I'm using the free charting software from the broker Thinkorswim. All right. So in this software, you'll find that you have drawing tools like in any other software. You just go to drawings, drawing tools, and you can draw trend lines using this tool here, or you can draw horizontal lines using this tool. All right. These are the two tools. I've also created a customized bar over here where I could draw the trend line or the price level as well. Okay, so this is, now I can put in the name of any stock I want. For example, let's look at Yahoo. So I key in the ticker symbol and it's going to plot Yahoo for me, and I can define the time interval as well. Okay, so as a swing trader, you want to use daily candles, which means each candle represents a day. I could look at the last 5 years, the last 3 years, the last 2 years, so on and so forth. So usually as a swing trader, I'll take a look at the last 1 year, and I can then zoom down to 6 months and 3 months. If I'm more of a long-term investor, I could take a look at the 3-year or the 5-year or even the 10-year chart, depending on my time frame. So in this case, I'm more of a short-term trader. I'll look at the 1 year or the 6 months daily chart, okay, or the day candle, right? So I'm going to click on 1 year. Okay, so I'm going to look at something like that. Let me expand it a bit more in this case. All right, there we go. Now, if I zoom, I can click and zoom in to any point, and you can see these are the candlesticks that represent the stock price. Now you have to select candlesticks in whatever software you're using. Usually under chart settings, again, any software will have chart settings. You have to select that you want, let me see where it is. Yeah, you got to select candlesticks, right? You got to select candles. If not, it may show you a bar chart or something else. So you want to select candles. And usually I will select white for bullish candles and red for bearish candles. You can use green and red as well, doesn't really matter. All right, so there we are. Okay, so I'm gonna take a look at Yahoo, and let's just take a look at this period of time, for example. Okay, so let's see if we can identify support and resistance levels. How? Well, let's look at price levels where the price tends to meet and then change direction. Okay, so you got to eyeball the chart and take a look if you can spot any of these levels. So I notice, for example, over here, the price tends to hit and reverse, hit and reverse, hit and reverse, right? So that's at least 3 times. So I'm going to click on my horizontal tool, right? And I could draw, click and draw. There we go. So this is a very obvious resistance, right? So it went up 1, 2, 3. All right. Remember, you need at least 3 points to draw a line. That's a confirmed resistance or support level. 2 times is a probationary, 3 times is significant, right? So you tested 1, 2, 3, 4, right? And you can see it broke the resistance. Can you see this is a break? Now, what happened after it broke the resistance? It came back down to test it. So now this resistance has become support, right? So it supports and it blows, it goes all the way up. Okay, so what some traders do is the moment it breaks out, they buy. But that's a bit risky because sometimes you could buy and it's a false breakout, it comes back down again. It's kind of like the prisoner breaks out of the jail, but it's caught back into the jail again. So a safer entry, if you're buying on a breakout, is to wait for the breakout and wait for the price to come back and to test that resistance to ensure the resistance has become a support, and then and only then when it bounces off the support do you then buy over here. Okay, now it then goes up and comes back down again, and what happens? That's right, it goes back to this level and boom, bounces off again. So you can see that this is a very strong level. This is $38. $38 was a very strong resistance over here, and it has become a very strong support level as well. Okay, where else could I draw? Well, I have spotted one over here as well. Click. There you go. So this obviously is a strong support, right? 1, 2, 3, 4, 5, right? Boom, right? And again, like I said, these are zones. So sometimes it can go a bit below like that and then, you know, bounce back up again. So you got to give some buffer. So this you can see was a consolidation. It consolidated and it broke out of the consolidation, formed a new uptrend. This was an uptrend that lasted just for 2 months. Downtrend, uptrend. Okay, so when you look at the chart, you have to identify what this is a sideways trend. That was a short-term uptrend. This was a downtrend, and this was an uptrend. So currently we are on an uptrend over here. Okay, over here we're on a downtrend, uptrend, sideways trend. So when you look at the chart, the first thing is to identify what are the trends you see. Okay. All right, let's see what else can I draw. Are there any other significant levels I could draw? Well, you can see one over here as well. I'm going to draw my horizontal line. There we are. Okay. By the way, this is called a gap. So a gap exists when the price closes at a certain price and the next day it opens at a far away price. So there's a gap, right? Usually this is caused by some news that was really good that happened when the market was closed, and when the market opened, people were willing to pay a much higher price than where it closed the day before. So it causes a gap, right? So it gapped up, right? It forms a support, 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 right? Breaks the support, becomes resistance, 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 resistance. Breaks the resistance, becomes support, and boom, it goes up and starts that trend. Okay. In fact, you could draw another line over here. There you go. Very good example. Can you see that? So you've got a resistance, 1, 2, 3. 3 is significant, right? It breaks the resistance, boom, resistance becomes support, starts the new trend. There we are. So if you zoom in, right now it's on an uptrend. So on an uptrend, we could see if we can draw a trending support level. Okay, so I'm going to go to my trending support tool, trend line. Okay, so I got to connect at least 3 points for it to be significant. And if I can't connect it, I won't force it. So it doesn't always look nice. If it doesn't, I won't force it. So could I connect this, and could I connect it? So sometimes it can be quite subjective, like do I connect it here or here, right? So I would rather connect it here. Why? Because it touches more points, right? 1, 2, 3, 4, 5, 6, right? So that is a significant trending support. Okay. So right now the price is here, and would I want to buy over here? Well, probably not, because it's a bit far from the support level. I like to buy it when it's on an uptrend, but it is near the support level. It's bouncing off the support. That's the ideal point. Of course, I would also put in my moving averages, which you're going to learn in the next part of this lesson. But for now, you can see that we are on an uptrend, but we are a bit far from the support level. I prefer if we buy closer to the support level, right? So there we are. So that's how I draw. I would draw these support and resistance levels for Yahoo. Take a look at this. This was a downtrend, you can see over there. Could I draw a trending resistance? Let me take a look if I could draw one. Again, does it connect 3 points? It has to connect 3 points, right? If it doesn't, I won't force it again. So connect that. Where does it connect 3 points? There. All right. So there you go. 1, 2, 3. That's a resistance. It broke above that, found support, and boom, went up there. There you go. All right. So the first thing I do when I look at a chart is to draw support and resistance levels. Why? Because remember, these levels tell me where price is probably going to reverse. Okay? So before I go long, I want to ensure there's no resistance just above my entry. If I want to go short, I want to make sure there's no support near my entry. And that's the only reason why I draw these lines. Okay? So once I draw these lines, the next step is to put in my moving averages, which we're going to learn in the next session. So let's move on to moving averages in a short while. Alright, so let's take a look at another stock, Boeing. Alright, so I've put in Boeing into my ticker over here, and I've selected daily candles, 1 year daily candles. Oh, I think I've selected 2 years, so we can take a look at more. Right, there we go. So it's a 2-year chart, and once again, I will look at it and see, are there support and resistance levels that are obvious? So I will go to my drawing tool, okay, and that's right, I will see one over there. That's pretty significant, won't you say? And again, I want to draw a line where it touches as many points as possible. So this was a very strong support, right? Resistance, 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 resistance. So let me ask you this. If you knew that there was a resistance over here, for example, okay, right, and you wanted to buy here, would you want to buy here at 147.75? No. Why? Because you know that there's a strong resistance at 150 over here, or 149.85. So this tells you that there are many sellers waiting to sell. So you wouldn't want to buy here, because what would have happened if you had bought? Right? You thought, hey, I buy here, it's going up really good, and what happens after that? Boom! right? You can see it comes back down because it can't break this resistance. So to be safe, like what you've learned, and oh, look at that, it went all the way down, my God. Imagine if you had bought here, right? So again, to be safe, you want to make sure that the price, okay, has broken above, in this case, right, broken above that resistance, and again, safely wait for the retracement, and the resistance has become support. And that would be a safer time to buy, knowing that the prisoner has got out of the jail and is now running into a new uptrend. All right, so that's why we draw and helps us to make good decisions. All right, where else can we draw? Now there's a pretty significant line over here as well. All right, can you see that? So resistance became support, support broke support, became resistance, became resistance, became resistance. Right? So again, imagine if you knew this or you saw this, would you want to buy here? I mean, say it's going up, I'm going to buy, boom, it goes down, right? Because there's a resistance. So wait for it to break above that resistance and then retrace down, all right, before buying. And if you can stay above that resistance that's become support, then we know that it's safe to enter the trade. Okay? You could also notice one over here. There we go. Support, 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 support. So again, if it's going down, you say, I'm going to short the stock. Would you want to short it here? No. Because you short it, it's going down and boom, it goes up and you're losing money, right? So before you short, ensure there's no support level just below your entry that you're going to short, all right? So these are really clear. Now let's zoom in. Here's an uptrend. So on an uptrend, could we draw a trending support? Again, can we connect three lines? Yes, we can. There we go, right? So 1, 2, 3, 4, 5, 6, right? So 6, very strong support. Now what has happened over here? You can see that it broke support and support became resistance. Becomes resistance. Boom, comes back down again, right? So you can see that these levels are really important to look at when you are entering a trade. Alright, so let's take a look at moving averages. Moving averages are one of the most popular and effective tools used by investors and traders. So what's a moving average? A moving average is an indicator that you can find in any charting software. And under the demonstration of the charting software, I'll show you how you can install these moving averages in just a few seconds. So let me just show you how it works. For example, in this chart, I've put in the 50 MA or the 50 moving average. So what the computer does is it will draw this blue line, which is the 50 moving average. So what does it really mean? 50 moving average means that the software will take the last 50 days of the stock's closing price, add it together and divide by 50. And it keeps repeating this process every day, taking the last 50 days and dividing it by 50. So you get the 50-day average. So this is then plotted on a chart and is shown as a line. And again, you can determine the color of the line. I like to use blue for the 50 moving average. So why are moving averages really powerful? Because these lines indicate, number one, the direction of the trend. Number two, they also act as strong support and resistance levels. Okay? There are two kinds of moving averages. You have the simple moving average and the exponential moving average, the SMA and the EMA. So the simple moving average is the simple average of the price over a predefined number of periods. For example, 50, right, is a predefined period, or 100 or 20. And again, a period could be a day, it could be an hour, it could be a week, right? So what you're seeing here is the 50-day simple moving average. Okay, 50-day simple moving average. Now, I also use exponential moving averages. The difference is that for an EMA, the computer doesn't take 50 days and divide it equally. All right, it places more weight on recent prices as compared to prices that were back not so frequent. Okay, it applies more weight to recent prices, so it is a weighted moving average. So people often ask, which is better? There's no right or wrong. They both have pros and cons. EMAs tend to react faster to price movement. They tend to change according to the price movement faster, but they tend to be less stable. They tend to give more false signals. So I tend to use simple moving averages when I look at 50, 100, 150, and 200 moving averages. In other words, the longer moving averages. But for the shorter moving averages, like the 20 and the 40, or the 6 and the 18, I use the exponential moving averages. Now, you don't have to remember all this right now, because when we go into the specific strategies or trading systems, I'll show you exactly which moving averages to use and which EMAs or SMAs to use. Yeah? So this is really an introduction to understand how moving averages work, how they behave. So when you look at a moving average, the first thing is to look at the slope of the moving average. And the slope tells you the direction of the trend. So in this case, you can see it is sloping up, right? The blue line is sloping up, indicating an uptrend. And oftentimes on an uptrend, the price, which is shown by the candlesticks, the price is above the moving average. All right, so let me repeat that. When the prices are above the moving average, and when the moving average is sloping up, it's a clear uptrend. So in this case, you can see it's an uptrend, right? And then what happens over here? Over here, notice the blue line is sloping down. When it's sloping down, it's a downtrend, right? And usually the prices are below the moving average when it's on a downtrend. Over here, what happens? The price gets above the moving average again, and it starts sloping up. All right, so this is an uptrend, this is a downtrend, and that is an uptrend. All right, pretty straightforward, right? Okay. Next, notice that on an uptrend, the moving averages act as support on uptrends. So on an uptrend, notice the moving average acts as a support level. So whenever the price moves to the moving average, what happens? That's right, it bounces off the moving average point, right? Now, it doesn't always happen, but oftentimes in very liquid stocks, right, the moving averages act as a support level. Right, over here you can see as well, right, it hits the support, bounces off, bounces off, bounces off, bounces off, right? So that's a very, very significant support level, right? And on the downtrend, what happens? The moving average acts as a resistance, right? Can you see the price goes up, boom, comes down, boom, comes down, right? Right? And what happens is we say prices tend to revert to the mean. Okay, so what does it mean? Notice that when the price gets too far from the moving average, it tends to move back to the moving average. It tends to snap back. That's why we call it an average. Okay, when it's too far, it snaps back. It's too far, it snaps back. So we call it the mean or the average. So whenever the price, so in this case you can see over here, for example, whenever the price has moved too far away from the moving average, it's overbought, right? It is overbought. It's overstretched, like a rubber band. And it tends to snap back to the average. Okay, so again, the moving average kind of tells you where the price should be at as an average. Okay, and again, notice that when a price gets too far from the moving average, what happens? It snaps back, right? It snaps back to the average. All right. So because of that, one of the most important rules is this: when you're buying a stock, okay, so remember you tend to buy on an uptrend, right? So over here you want to you want to buy, right? You want to go long, right? And so you only want to buy when the price is near the moving average, right? So in other words, you could buy over here, right? This would be a nice point to buy. You could buy over here, okay? Now, would you want to buy it over here, for example? No, I wouldn't buy over here. Why? Because the price has moved too far from the moving average. So it's risky to buy over here because there's a high chance that it will revert back to the moving average. Of course, it did go higher, right? So sometimes high can go higher, but eventually it will have to come back to the moving average. So these are very risky points to buy. You want to buy when it's near the moving average, right? It is kind of like surfing off the moving average, okay? Similarly, if I want to sell, I want to short, I want to sell when it's near the moving average. So I could sell over here, right? At this point, I could do a short, right? I could short it here. Oops, hold on. So I could short it over here. I could short it over here, right? Because I sell high and buy back low, right? Sell high, buy back low. They'll be safe. Do I want to sell it here? No, because the price has dropped too far from the moving average. It is oversold. So if I sell here, thinking it's going to go lower, it's risky because sure enough, it snaps back up again. So really important to understand how moving averages work. So a common question asked is, which moving averages do I use? All right. Now, it depends on the time frame. So in general, I use the 20 exponential moving average to look at the short-term trend of a stock. Okay, I use the 50 moving average to look at the medium-term trend, and the 200 moving average to look at the long-term trend. For example, so over here on this chart, you can see that this red dotted line over here, that is the 20 exponential moving average. Okay, the blue line is the 50 moving average, and the red solid line is the 200 moving average. All right. So, the 200 moving average, okay, is used to determine the long-term trend. So basically, whenever the price, as long as the price, the candles are above the 200 moving average, and the 200 is sloping up, it's on a long-term uptrend. So you can see that over this period of time, the price was above this red line, the red line was sloping up, so it's on a long-term uptrend. So if you are more of a long-term investor, you would take reference more to the 200 moving average. You won't be concerned with the short-term trends. You're looking at more of the longer-term trend, which is 200 MA, right? Now the 50 moving average, the blue line measures the medium-term trend. So over here you can see the price is above the blue line. That's a medium-term uptrend. Okay, and over here the price crosses below the blue line. That's a medium-term downtrend. All right, so uptrend, downtrend, and then the price goes above the blue line again, and the blue line slopes up. That's a medium-term uptrend. All right, so again, if I'm more of a medium-term investor, I'll take reference to the blue line, and only when the price is above the blue line would I consider going long. If the price is below the blue line, I consider going short. Now, if you're more of a short-term investor or more of a swing trader or short-term trader, you take reference to the 20 EMA, the 20 exponential moving average. People who are really very short-term, like intraday scalpers, they look at the 9 EMA, the 9 exponential moving average. So over here you can see that the price is above the 20 EMA. This is the 20 EMA, so that's a short-term uptrend. Right, over here is a short-term downtrend. Here's a short-term uptrend. Right, short-term downtrend. Okay, so over here you can see that the price was on a short-term downtrend, but still on a medium-term uptrend and on a medium-term. Let me repeat that. Okay, over here the price was below the 20 EMA. Right, so the price is on a short-term downtrend, but on a medium-term uptrend. Why? Because the price is still above the 50 MA blue line. And the price is also on a long-term uptrend because it's above the red line. So in other words, The price could be on a short-term downtrend, but medium-term uptrend and long-term uptrend, right? Or it could be on a short-term uptrend and medium-term downtrend and long-term downtrend. So you look at different trends, the long-term, the medium-term, and the short-term. Of course, the ideal time to go long is when all three trends are going up. So short-term uptrend, medium-term uptrend, long-term uptrend, all trends are going up. That is the best time to go long. Similarly, if you want to go short, the best time is when all three trends are going down, right? Medium-term downtrend, long-term downtrend, short-term downtrend as well. Okay? And I call this the EMA fan pattern. So besides the 20, 50, and 200, these are other popular moving averages, right? So we've got the 20, I've just shown you the 20. You can also put in the 40 EMA as well. So that's the 20 and the 40. You've got the 50 blue. Let me just draw it for you. So this is the 50 in blue. This is the 100 in brown. It's the 150 in green. And the 200 in red. Okay? So whenever you see this sequence, 20 is above 40. Alright? 50 is above 100, above 150, and above 200. When you see this sequence, it tells you that the MA fan is on a clear uptrend, and that's the best time to go long. Now, some of you may have this question. You say, Adam, what if the long-term trend is down, the medium-term trend is down, but the short-term trend is up? Could I go long? Yes, you could, but you are going long on the short-term trend, but the main trend is going down. So you could go long, but it's a bit more risky. So that takes a bit more experience, and we'll look at it in the specific strategies that will be coming in the lesson soon. Right? We call them more of a counter-trend trade, trading against the main trend, but with the short-term trend going up. You can do that as well. Okay, this is a MA fan structure on a clear downtrend. So a reverse, right? In this case, what happens? The 20 EMA is below the 40, right? This red line is a 20 and it's below the 40 blue line. So it's a short-term downtrend. The 50 blue line is below the 100 and it's below the 150, it's below the 200. So this is a very clear downtrend. All trends going down, best time to go short and ride that downtrend wave pattern. Alright, so that's all you got to know about moving averages for now. Again, in the specific trading strategies, the lesson plans, you will learn exactly which moving averages to use for which specific setup. Alright, so let me show you really quickly how you place your moving averages into your charts. Okay, so again, whatever charting software you use, any software will have moving averages. It's one of the most common tools used by traders. Yeah. So you got to find on your software where you can put in indicators, or we call them studies. So I'm using again the Thinkorswim charting software, which is a free software from Thinkorswim, which is a broker that you can use. So I'll go to what we call studies, right? Or we call them indicators, right? And again, there are over 300 indicators that we will learn. Some of them, not all of them are useful. So one of them would be called moving averages. Now you can always search for them. So put in moving average. There you go. So you see simple moving average. So you double click and it appears over here. So by default, they give you the 9 simple moving average. So I want to change it to, for example, the 50 moving average. So I'm going to click on this edit widget. There we go. Change to 50. And for 50, I love to use blue and width 2. So when I click OK, what happens? There we go. So I have my 50 moving average. There we go. So as long as the price is above the moving average, it's sloping up, that is a uptrend. Now over here, look at what's happening, right? The price is going below the moving average, it's sloping down. So this could be a change in trend, right? So this would be a scary time to go long. Yeah. Okay, let me put in more moving averages. So double click again. So this time I want to put in, for example, the 200 moving average, which is the long-term trend. Red. Width 2. Okay. So there we are. I can also put in the exponential moving average. Exponential. This one. Moving average exponential. 20 EMA. Red. Usually for exponential moving averages, I use a dotted line just to demarcate. Okay. Apply. Okay, there we are. So on Boeing, you can see I've put in my 20 exponential moving average, 50 moving average, and 200 moving average, right? So there we are. Okay. So again, during the specific strategies, I'll show you which exact moving averages to use. For this case, I'm just showing you how you can install it in your software. So let's go back to the lesson. So this concludes Lesson 3, Mastering Technical Analysis Part 1. I'll see you in Lesson 4, where we look at Part 2 of Technical Analysis. Till then, Adam Khoo signing off.